Momentum strategies have long tempted investors with the promise of high returns, but just as often, they've punished them with sharp drawdowns and sudden reversals. What if there was a way to keep the upside while controlling the risk? Today's video introduces you to a breakthrough called Hierarchical Momentum. This strategy doesn't just ride past winners, it restructures how we think about diversification, clustering, and stability in portfolio construction. If you've ever wondered how to improve on classic momentum without falling into its traps, stay with me. This is the next generation of smart investing. Chapter 1. What problem does hierarchical momentum solve? At the heart of most portfolio construction models lies a fragile promise. If we can estimate future returns and covariances accurately, we can build optimal portfolios. This idea forms the backbone of the Markowitz mean variance optimization framework. Yet in practice, the promise often breaks. The problem is not in the theory, it's in the data. When the number of assets grows large, estimation errors grow with it. Covariance matrices become unstable, and inverting them, required for optimization, amplifies these errors. The result is portfolios that look precise on paper, but behave erratically in the real world, often concentrating weight in a handful of assets based on noisy signals. Hierarchical momentum, or HM, offers a fundamentally different path. It doesn't try to optimize across every asset. Instead, it restructures the market into a tree, grouping similar stocks based on their behavior, and then picks only the strongest performer in each group. In doing so, it simplifies the decision space, avoids dangerous correlations, and builds a portfolio that is both focused and diversified. Chapter 2. How hierarchical clustering meets momentum. The hierarchical momentum strategy is a marriage of two powerful ideas, clustering and momentum. It begins by analyzing how stocks move together, using a correlation-based distance metric, and then applies hierarchical clustering. This technique, familiar in data science but rare in finance, builds a dendrogram, a tree-like map of the market where similar stocks are linked by short branches. Once the tree is constructed, the strategy slices it at a chosen level, creating a fixed number of clusters. Each cluster represents a set of assets that tend to behave similarly, often reflecting shared economic drivers like sector, region, or business model. Then comes the second step, momentum selection. Within each cluster, the strategy identifies the asset with the highest 12-month cumulative return. But there's a filter. Only assets with positive momentum are included. This ensures that the portfolio remains long only and avoids investing in declining trends. The final portfolio is composed of these top performers from distinct clusters, each receiving an equal weight. The result is a lean, diversified set of bets, each one a leader in its group. Chapter 3. Why it works. Empirical evidence from global markets. The numbers behind hierarchical momentum speak volumes. Across a comprehensive data set of international stocks, spanning 23 developed and 24 emerging markets from 1997 to 2022, the strategy consistently outperformed. Not only did HM deliver higher Sharpe and Sortino ratios compared to both model-based and model-free benchmarks, but it also did so after accounting for transaction costs. More impressively, it generated statistically significant alpha, meaning that its returns cannot be explained by exposure to common market factors like size, value, or momentum itself. Equally important is how HM performs during market stress. Traditional momentum portfolios are notorious for suffering large drawdowns. HM breaks that pattern. Thanks to its diversified structure and careful selection process, it shows lower volatility and fewer deep losses, even during turbulent periods. This makes it not just a high-return strategy, but a resilient one. Chapter 4. Fixing momentum's flaws without giving up the premium. Momentum is powerful, but dangerous. It tends to create portfolios filled with concentrated bets on assets that have recently performed well. When momentum reverses, as it often does, these portfolios are hit hard. Hierarchical momentum addresses this flaw elegantly. Instead of blindly buying top performers across the entire universe, it narrows the field by clustering. Within each cluster, it selects just one asset. This naturally spreads risk across distinct regions of the market, even if all chosen assets have positive momentum. This structure not only reduces exposure to correlated losers, but also enhances stability across economic regimes. When one sector underperforms, others may hold firm. The result is a smoother ride without giving up the core return engine of momentum. Chapter 5. Why HM beats other advanced methods. While many advanced strategies try to fix traditional optimization through shrinkage estimators or factor models, they still rely on the same core weakness: estimating and inverting large covariance matrices. These techniques can be fragile and opaque. Hierarchical momentum doesn't try to patch the old system, it replaces it. By avoiding optimization altogether and building portfolios through structure and selection, HM sidesteps error amplification. It uses the actual behavior of the market, revealed through clustering, to guide allocation. That's both intuitive and effective. Moreover, HM doesn't require shorting, doesn't assume any factor exposure, and doesn't rely on complex parameter tuning. It's clean, replicable, and practical. And best of all, it's been shown to outperform, with a statistically significant alpha to prove it. Chapter 6. The dataset and rigorous testing behind HM. A strategy is only as good as the data and methods that support it. HM is backed by a robust empirical framework. The dataset includes thousands of stocks from the MSCI ACWI index, covering over 50 countries and 25 years of history. Importantly, this data is free from survivorship bias. Companies that enter and leave the index are accounted for dynamically, ensuring a realistic investment universe. The strategy is tested with realistic constraints: monthly rebalancing, approximately 300 assets, and 20 basis points of transaction costs per trade. Out-of-sample testing is performed extensively, and the results are validated using rigorous statistical techniques. Time series regressions, Sharpe ratio difference tests, and variance comparisons all confirm that HM consistently outperforms its peers, not just in raw return, but in true, risk-adjusted terms. Chapter 7. How sparse allocation makes the portfolio smarter. The brilliance of HM lies not only in what it selects, but in how little it selects. After clustering the market into groups, it picks just one asset per group. This results in what's called sparse allocation, a portfolio that holds fewer assets, but with better diversification. This sparsity reduces noise, mitigates overfitting, and keeps the strategy focused. By avoiding complex optimization and equal weighting the winners, the strategy is simple to implement yet powerful in outcome. It's a minimalist approach to diversification, one that achieves more by doing less. Chapter 8. What the alpha really means. At the end of the day, alpha is the ultimate test. If a strategy delivers returns that can't be explained by known factors, it's doing something different, something better. Hierarchical momentum delivers exactly that. Even when tested against the full FAMA French 5-factor model, including momentum, and more global models like Jensen, Kelly, and Pedersen's 93-country factor framework, HM still generates positive, statistically significant alpha. This isn't luck, it's not just another factor in disguise. It's evidence that the combination of market structure and momentum timing creates a genuine edge. For investors, this is gold, a repeatable source of excess return that holds up under scrutiny. Hierarchical momentum is more than a clever tweak to traditional investing. It's a rethinking of how portfolios should be built in a high-dimensional, noisy, and interconnected world. It captures the upside of momentum while protecting against its biggest risks, all through an approach grounded in structure, simplicity, and smart design. If this inspired you to rethink your own investment process, make sure to like the video, share it with your colleagues, and subscribe for more high-level content on the future of quantitative finance. Because in the world of smart investing, understanding structure is the new alpha.